Hi everyone, welcome to live session on multi-asset funds. Today we are joined by our esteemed partners who will help us understand how multi-asset funds operate and what are the benefits of investing in these funds. Our first panelist is Mr. Ankit Sehgal. He is the MD of Flexi Money and has over 15 years of experience in the financial services industry across commercial and private banking. He was associated with Citibank for 10 years as Senior Citi Gold Relationship Manager. Our second panelist is Mr. Gajendra Kothari. He is the MD and CEO of Etica Wealth. He has more than 19 years of experience across Indian and overseas capital markets and is leading Etica Wealth since 2011. Our third panelist is Mr. Anand Rathi. He is the co-founder of Mira Money, an alumnus of IBS Hyderabad and ex-banker. Mr. Rathi has an investment management experience of over 20 years. Our final panelist is Mr. Sajal Roy. He is the founder of Anjali Investments. He has over 25 years of experience handling various clients across the spectrum. Under his leadership, Anjali Investments has grown to become one of the largest and most trusted names in the Eastern region. A very warm welcome to all the partners. To start the discussion today, Anand sir, my first question is to you. What asset classes do multi-asset funds invest in, and what is the strategy followed by these funds?
So thanks, Bableen. In general, multi-asset funds invest in 3 or more different types of asset classes, and they have to, as per SEBI, invest at least about 10% in each asset class. And in terms of asset classes that they cover, what I've seen is they invest in international equity, they invest in Indian equity, they invest in debt, they invest in commodities, they also invest in real estate. Now, talking about strategy, what I've seen, again, fund managers follow are 2 different types of strategy. One is a very static asset allocation strategy where they keep the asset allocation the same. Say, for example, they'll say, I will keep debt investments at 10% or real estate investment at 20% and so on and so forth, which would mean they will keep rebalancing their portfolio on a regular basis. On the other side, there is also dynamic asset allocation few fund managers follow, which ideally means that based on the view that particular fund manager has on that particular asset class, he may add 10% sometimes, he may add 20% sometimes, or he may go to 30% sometimes based the fund that he is planned for. So these are the 2 things about dynamic multi-asset funds.
Awesome. Gajendra sir, my next question is to you. As an asset allocation proposition, what are the benefits multi-asset funds offer?
Sure. See, we always, as financial advisors, we always tell people that asset allocation is the biggest variable in overall long-term performance of any client's portfolio, right? One should really practice asset allocation all the time, whether markets are down or whether markets are up. And there are different asset classes, mainly equities, bonds, gold. Within equities, you have international equities, domestic equities, developed world equities, emerging markets equities. And each of them follow different cycles over different period of time. And one truth about any asset class is that it is always cyclical. No asset classes will always go up or go down. They always have a cycle. Sometimes it can be a short cycle, sometimes it can be a long cycle. So it is, and another thing is very difficult to predict which asset class is going to outperform in which calendar or financial year. So we don't know that. That is where multi-asset funds come and add diversification to the portfolio. It is a one-stop solution for almost 80-90% of the investors, where within the same fund they can benefit the power of equities, stability of debt, and diversification from other commodities like gold and silver. So, and one rule of asset allocation is that when you diversify, you should diversify in those assets which are not correlated or very little correlated to each other, which means if equities are doing well, gold might not do well. And that is the idea of adding gold, so that you are reducing volatility. So when markets are going down, at least the other asset class is going up or is positive, and that is why you will not see a huge negative in your portfolio. So over a period of time, this diversification helps in risk reduction, or helps deliver the portfolio a very optimally risk-adjusted return, which is what investors look forward to.
Thank you, sir. Sajal sir, same question for you. We'd like to know your views. What are the benefits that these funds offer? Why should these be part of an investor's portfolio?
Good afternoon. This multi-asset funds is a unique proposition for investors who wants to invest with a little bit of risk. So asset classes we know follow different cycles over a different period of time. So gold has performed very well from 2000 to 2012. Developed market equities have performed very well from 2008 to 2020. And everybody knows it might be a decade of India. So different asset classes follow different cycles. It is very difficult to predict which asset class will outperform when. Multi-asset funds also help in diversification. We get that stability of that equity, benefit of debt, and also diversification from commodities. Many people are saying now this can be the decade of commodities. So why not invest in commodities through these funds? An investment in weakly negatively correlated asset class sometimes reduces the volatility and helps to leading to optimal risk adjusted returns. And the benefit of tax efficiency in this fund, the investors can also get. So that is the benefit of investing in MAC.
So investment in weakly correlated asset classes, helps in reducing the volatility and leads to optimal risk-adjusted returns.
Right.
Now, Ankit sir, what is the benefit of adding overseas equity to one's portfolio? So in these funds generally would invest in domestic equities, overseas equities also. So what is the benefit an investor can get?
See, when we invest in overseas equities, and I think the rule is same, like in India also, we diversify various sectors, various caps, whether it is small cap, large cap, mid cap. So it also becomes very important for risk management to diversify across the economy. So when you go, when you invest in overseas economy, you actually get a lot of companies which you can't get in India. For example, I think Google is one across the globe. So if you want to take the part in the profits of Google, you have to go to US and invest in those companies. Microsoft, Netflix, all these are giant companies which are not available in our economy, right? So in order to get the benefit out of these companies, definitely it makes a lot of sense to go and invest overseas in the international markets. These are the companies which comes to India. They have India as the biggest market. They earn and then they benefit their shareholders in their country. Then why not India also take part in that profits? Since we are the biggest, one of the biggest markets for them. So it makes sense to invest in international this thing, and plus also sectoral diversification. For example, I think if you want to invest in the biggest companies in defense, then US is one of the biggest defense market. If you want to invest in Israel for tech companies, then Israel is the biggest market for that. If you want to invest in the automobile segments, then Germany is there, right? So in order to capture all these biggest sectors, you can go and you can invest in international markets. This makes sense for the investors. Plus also, there's a lot of currency gains which we can see. We have seen dollar appreciating over a period, right? So I think if you want to get the gains from the currency also, I think that also makes sense. So I think that is a reason why clients should have international equities in their portfolio, which will give them cushion also, because it's inversely correlated. Many times we have seen it's inversely correlated to domestic equities. Whenever there has been an outflow from the FIs in India, it goes back to US and gets invested in that market. I think that also is very, very important. So that's why I think clients should have international equities in their portfolios.
Right, sir. And how about exposure to gold? Why shouldn't investors consider an exposure to gold in their portfolios?
I think gold is a very important risk management, very important for managing risk in the portfolio. Let's understand the importance of gold in the economy. Right, so money can be produced, gold cannot be. Gold is limited, and when something is limited, then obviously the demand of that thing is really high, and then obviously there's upside potential also. So let us understand what has happened in the history. In the history, whenever there has been a crisis, gold has always come to the rescue. So whether it's a Lehman Brothers crisis, whether it's a COVID crisis, all the corporates, all big balance sheets have gone and taken gold support while selling the gold in the market to rescue them out in that situation. So I think gold is very important and is a very important insurance in the portfolio, which will help the overall portfolio during the crisis time. And also, since I've said that it cannot be controlled by any of the economies, like US can control USD, but gold is no asset class which cannot be controlled, and that's the reason why we are seeing de-dollarization happening as a concept, and a lot of economies, a lot of central banks are buying gold left, right, and center. Right. So I think that's the reason gold has to be there in the portfolios. It will act as a hedge. It will act as your life savior once if there is a distress in the economy, and it's also very good diversification tool in the overall scheme of the portfolio. So I think gold will definitely add glitter to the portfolio if there is a darkness around. So that's what I can say.
Sure, sir. Now let's talk about Nippon India Multi-Asset Fund. Gajendra sir, what is the strategy followed by this fund?
Yeah, so Nippon India Multi-Asset Fund follows a very unique strategy. It invests in four different asset classes. You have domestic equities, overseas equities, fixed income in India, and also commodities. So, 50% of allocation broadly would be in the multi-cap portfolio within Indian equities. And of course, within multi-cap also the focus will be more on large cap, because this fund is intended for more conservative investors or somebody who is first time investor, wants to invest into different asset classes, or first time into mutual funds altogether, coming with a 3 to 5 year time frame, doesn't have a very long time frame. So multi-cap domestic portfolio with a large tilt towards large cap would give that cushion of volatility. Then the fund also would invest 20% of allocation in overseas equities, and they would invest this through the iShares MSCI World ETF, which means in the 20% you're buying entire world stock market index. That includes developed markets, emerging markets as well. So that's a great mix. And that's an index fund route, which is a low cost kind of a strategy. That would bring the overall cost of the fund down as well. And then 15% in a very high grade portfolio of Indian fixed income shorter term bonds. Again, the advantage of shorter term bonds is it is going to be less volatile, and high grade portfolio will ensure that the money is going mostly in AAA kind of security. So very low chances of credit risk in the portfolio. This is to provide the cushion, compared to equities. And finally, commodities will have around 15% allocation, of which 10% minimum will be in gold. Again, nowadays we have silver also available to invest in India. And over a period of time, as in more different commodities are available, the fund can invest in other commodities. So overall, if you see, it's a blend of four broadly different asset classes, and with very low correlation to each other. And that should provide really good real risk-adjusted return over a 3 to 5 year period.
So as Gajendra sir mentioned, the Nippon India Multi-Asset Fund invests in 4 asset classes. Anand sir, how are the capital gains for the scheme taxed?
So capital gain in this particular asset is primarily based on long-term and short-term gains. And the long-term is only when you hold that particular asset for more than 36 months, which is 3 years. And so long-term is 3+ years and short-term is less than 3 years. And again, basis your residential status, if you're a resident individual or an NR, the taxations are going to be different. So for a regular short-term income, your taxes will be applicable as per your tax slabs. The moment you're in the long-term tax slab, for resident individual, it will be 20% with indexation benefit, while in the case of a non-resident, it is 10% flat taxes. So the indexation benefit continues to apply to this particular asset class, even though it was abolished for most of the other schemes after 1st of April or so.
Sure, sir. Sajal sir, what category of investors should consider this fund?
This category is basically for all-weather proposition. The conservative investors who are looking for a superior risk-adjusted return across market cycles with tax efficiency can invest this type of funds. And the first-time equity investors who just want to test water, they can also invest. So it's basically for a conservative, tax-efficient investment proposition in MAF.
Sure, sir. I'd like to thank all the partners for sharing their valuable insights. To summarize, multi-asset funds invest in 3 or more asset classes with minimum 10% investment in each asset class. Diversification is the key here. We are talking about investing in weakly correlated asset classes, which may help investors to generate superior risk-adjusted returns across market cycles. Thank you, everyone, for joining in today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.